If you were born before January 2nd, 1961, do not file your 2025 tax return until you check for this new $6,000 deduction. There is a senior deduction tied to a new IRS schedule, and if the right section is missing from your return, the IRS is not going to call you, warn you, or politely add it for you. In this video, I'm going to show you what this $6,000 senior deduction is, who may qualify, where it can disappear on the return, and the exact lines to check before you sign or file anything. This is the part seniors need to understand immediately. A deduction you do not claim is not a deduction you receive. A form your preparer does not attach is not a form the IRS fills in because you are over 65. And a tax software screen you click through too fast can quietly cost you money before you even realize what happened. This is not some rich person loophole. This is not a complicated investment trick. This is a senior tax deduction that can be worth up to $6,000 for one eligible senior, or up to $12,000 for a married couple when both spouses qualify. But it only helps if your return claims it correctly. That is the problem. Not fraud, not laziness. A routine, the same folder as last year, the same preparer, the same tax software, the same quick signature. And this year, that old routine can be expensive. This video is for educational purposes only. It is not personal tax advice. Your filing status, income, state, social security number, and full tax return can change the result. So confirm your specific situation with a qualified tax professional or the IRS instructions before filing. Now let's get into the part that matters. Because if you are 65 or older, the question is not only, do seniors get a deduction? The real question is, did my return actually claim it? The title says, born before January 2nd, 1961, because that is the birth date checkpoint shown for the 2025 Enhanced Senior Deduction. The return you file in 2026 is based on your 2025 tax year. For this deduction, the key point is being 65 or older by the end of the tax year. That does not mean every senior automatically gets the full amount. It means your return has to be checked. Not assumed, checked. A lot of people hear senior deduction and immediately think, I already get that. My software knows I'm over 65. Maybe it does, maybe it does not. Maybe your birth date was entered correctly. Maybe your spouse's birth date was entered correctly. Maybe your filing status allows the deduction. Maybe your income does not phase it out. Maybe Schedule 1A was completed correctly. That is too many maybes for a return that affects your money. And here is where seniors get caught. This enhanced senior deduction is not the same as the older extra standard deduction seniors have had for years. That older age-based standard deduction still matters. But this newer deduction is separate from that older rule. So a taxpayer can be familiar with the old senior deduction and still miss the new one. Another important point, this deduction can matter whether you take the standard deduction or itemize, but it still has to be claimed correctly. That is how mistakes happen. The senior walks into the tax office with a folder, Social Security statement, pension form, bank interest form, IRA withdrawal form, maybe a brokerage form. Everything looks normal. The preparer enters the numbers. The refund or balance due looks believable. Nobody stops. Nobody asks about the enhanced senior deduction. Nobody checks Schedule 1A. The return goes out, and once it goes out, the IRS processes what was filed. It does not act like a personal retirement advisor saying, wait, Margaret, you forgot something. No, the tax return is the claim. If the claim is incomplete, the result can be incomplete. That is why older taxpayers need to treat this return like a checkpoint, not a habit. Now let's clear up the biggest misunderstanding. This $6,000 is not automatically a $6,000 check. Do not let anyone explain it that way. It is a deduction. A deduction reduces taxable income. It can lower the federal income tax you owe. It can increase your refund if too much tax was withheld. It can help seniors with taxable pensions, IRA withdrawals, part-time wages, investment income, interest income, or taxable Social Security. But if someone already owes no federal income tax, and there is no refundable credit involved, this deduction may not turn into cash. That does not make it useless. It means you need to understand what it actually does. If the IRS is taxing part of your income, this deduction may push some of that income out of the taxable zone. For example, if $6,000 of income would have been taxed at 12%, that can mean about $720 less in tax. If it would have been taxed at 22%, that can mean about $1,320 less in tax. For a married couple where both spouses qualify, the deduction can be up to $12,000, so the tax savings can be larger. But the exact benefit depends on your return, your income, your filing status, your tax bracket, your deductions, your withholding, your Social Security taxation, your IRA withdrawals, your full situation. So no, this is not a guaranteed $6,000 check. Some seniors will qualify, some seniors will not. Some will get the full deduction, some will get a reduced amount. Some will be phased out, but the seniors who never check are the ones who lose before the calculation even starts. The worst tax mistake is not asking and finding out you do not qualify. The worst tax mistake is qualifying and never asking. There are 5 places this deduction can disappear. The first place is age. The rule is not retired. It is not on Medicare. It is not receiving Social Security. For the 2025 enhanced senior deduction, the key test is whether the taxpayer was born before January 2nd, 1961. That matters because some people retire at 62 and assume every senior tax rule already applies. It does not. Other people are close to the age boundary and need to check the exact rule instead of guessing. So the first question is simple. Does the return show that you meet the age requirement for this deduction? The second place is your Social Security number. You, and if married, your spouse, must have a valid Social Security number to claim this deduction. Do not treat identifying information like a small detail. On a tax return, small details can block big results. The third place is filing status. This is especially important for married couples. For this senior deduction, if you are married, you must file jointly to claim it. That means filing separately can become expensive. Some couples file separately because of old habits, medical expenses, past debt issues, state issues, or because someone once told them it was better. Maybe there is a reason, maybe not. But this year, that decision has to be reviewed. A married couple should ask out loud, if we file separately, are we losing the senior deduction? That question can change the entire return. The fourth place is income. This deduction phases out at higher modified adjusted gross income levels. The threshold is $75,000 for single filers and $150,000 for married couples filing jointly. The phase-out is not random. Schedule 1A reduces the deduction by 6% of the amount your modified adjusted gross income is over the threshold. So some seniors get the full amount, some get part of it. Some higher income seniors may get none of it. This is why guessing is dangerous. A senior may say, I probably make too much, maybe not. Another senior may say, I definitely qualify. Maybe not fully, the return has to calculate it. The fifth place is the new schedule. This is the big one. On the 2025 Schedule 1A, the senior deduction is in Part 5, called Enhanced Deduction for Seniors. The Enhanced Deduction for Seniors shows on line 37. Then the total additional deductions flow from line 38 to Form 1040 or Form 1040 SR line 13B. Your job is not to memorize the tax code. Your job is to ask one clear question: where is Schedule 1A on my return, and where did the senior deduction show up? If the person preparing the return cannot show you where it is, do not ignore that feeling. Pause, ask again, because if the answer is real, it should be easy to point to. Now let's talk about the conversation that can save you from a quiet mistake. Many older Americans hand over their tax papers, wait quietly, sign where they are told, and leave. That may feel polite, but politeness does not fix a missing deduction. You do not need to be rude. You do not need to pretend you are a CPA, but you do need to be firm. Here's what you say. I am checking the enhanced senior deduction. Before this return is filed, I want to confirm whether Schedule 1A was completed correctly. Then ask, is Schedule 1A attached? Then ask, does Part 5 show the enhanced deduction for seniors? Then ask, what amount is on line 37? Then ask, did line 38 flow to Form 1040 line 13B? And then ask the question that protects you from a vague answer. If the amount is not the full amount, is it because of income phase-out, filing status, Social Security number, or another eligibility rule? That last question matters, because sometimes the amount should be lower. Sometimes it should be zero, but you deserve to know why. Do not accept a vague answer like, the software handles it. Maybe the software does handle it, but software only works with the information entered into it. If your date of birth is wrong, software can be wrong. If your spouse's information is missing, software can be wrong. If your filing status is wrong, software can block the deduction. If your preparer is rushing through returns based on last year's pattern, a new line can be missed. This is not about attacking tax preparers. Good preparers will not be offended by a clear question. A good preparer should appreciate that you are paying attention. The dangerous situation is when a senior is too quiet, too trusting, or too embarrassed to ask. This is your return, your signature, your money, your responsibility. If something is missed, you are the one who lives with the result. Now stop for 1 minute. Do not think like a taxpayer. Think like the IRS computer. The IRS computer does not care that you worked for 40 years. It does not care that groceries went up. It does not care that your Medicare premium increased. It reads boxes. It reads lines. It reads numbers. It reads what was filed. That is the shift seniors need to make. You are not asking the IRS to be generous. You are making sure your return claims what the law allows. If the senior deduction does not land in the right place on the return, your good intentions do not matter. The paperwork matters. The IRS does not reward memory. It processes documentation. So stop saying, I hope my preparer got it. Replace that with, I want to see where it is. That one sentence can protect you from signing a return you do not understand. Now married couples need to pay close attention, because this is where the number can double. If one spouse qualifies, the deduction can be up to $6,000. If both spouses qualify, the deduction can be up to $12,000. But that does not mean every married couple automatically gets $12,000. Filing status matters. Income matters. Age matters. Identification matters. The return matters. Two couples can be the same age and have similar income, but end up with different results because one couple files jointly and the other files separately. That is why filing status should not run on autopilot. The married couple should ask, did we qualify for $6,000 each? Did our income phase it out? Did filing jointly help us claim it? If we did not claim it, what exactly stopped it? Those are not complicated questions. Those are responsible questions. And seniors should not apologize for asking responsible questions about their own money. Here is another common mistake. Some seniors will hear about this deduction and say, I do not owe taxes anyway, so this does not matter. Maybe that is true, but do not decide that from memory. A lot of seniors say they do not owe taxes because they did not owe last year, but this year may not be last year. Maybe you took a larger IRA withdrawal. Maybe a bank CD paid more interest. Maybe your brokerage account produced capital gains. Maybe you sold stock. Maybe your spouse passed away and your filing status changed. Maybe part of your Social Security became taxable. Maybe your pension withholding was too low. Maybe you worked part-time. Maybe you had one unusual income year. One changed number can turn a simple return into a taxable return. And if that happens, a deduction can matter. This is why seniors should not dismiss the new deduction just because their return used to be small. Tax returns age with you. Your income changes. Your health costs change. Your filing status changes. Your withdrawals change. Your deductions change. The law changes. So the question is not, did I owe last year? The question is, what does my 2025 return show now? That is what matters. Not memory, not habit, not last year's refund, this year's return. By now, you know the real checkpoints: age, Social Security number, filing status, income phase out, Schedule 1A, Part 5, Line 37, Line 38, Form 1040, Line 13B. Most seniors will never ask those questions before they file. So if this is helping you protect your return, tap the like button so more seniors see this before they file wrong. And subscribe to Seniors Heaven, because the next tax changes are not written in plain English, and I am going to keep breaking them down without the nonsense. Now keep watching, because the next section is the checklist you can use before you approve the return. Not theory, not tax talk, the checklist. Before you file, do not only look at the refund amount. That is the number everyone stares at. But the refund amount does not tell you whether the deduction was claimed correctly. It only tells you the final result after everything was entered. You need to look at how that result was created. Here are the 7 things to check. First, check your date of birth on the return. If you are married, check your spouse's date of birth too. A wrong birth date can create the wrong tax result. Second, check your Social Security number. Not from memory. Look at it. Make sure the name and number match official records. A typo on a tax return is not harmless. Third, check your filing status. Single, married filing jointly, married filing separately, head of household, qualifying surviving spouse. Do not let this line run on autopilot. If you are married and not filing jointly, ask whether that blocks the senior deduction. Fourth, check your income level. Ask whether your modified adjusted gross income reduced or phased out the deduction. Do not guess based on how rich or not rich you feel. The return has the number. Use the number. Fifth, check Schedule 1A. Ask to see it. If you are using software, open the actual forms view or PDF preview. Do not stop at the summary screen. Sixth, check Part 5, Enhanced Deduction for Seniors. Ask what amount is showing on line 37. If it is $6,000, ask what confirms you received the full amount. If it is less than $6,000, ask what reduced it. If it is 0, ask what rule made it 0. The question is not just, do I get it? The stronger question is, if the amount is 0, what specific rule made it 0? That forces a real explanation. Age, income, filing status, Social Security number, something. Seventh, check that the deduction flows to the main return. Schedule 1A, line 38, should flow to Form 1040, or Form 1040 SR line 13B. The deduction should not sit on a form-like decoration. It has to affect the return. Ask your preparer, where does this flow on Form 1040? If they can show you, good. If they cannot, slow down. Do not sign a mystery document. And if you already filed, use the same checklist. Get a copy of your return. Look for Schedule 1A. Look for Part 5. Look at line 37. Look at line 38. Look at the main return. If you cannot find it, contact the preparer or open your tax software file and ask, was the senior deduction checked on my return? If the answer is yes, ask where it appears. If the answer is no, ask why. Maybe you did not qualify. Maybe income phased it out. Maybe filing status blocked it. Maybe a Social Security number issue stopped it. Or maybe it was missed. If it was missed and you were eligible, ask whether an amended return is needed. Do not panic. Do not guess. Get the reason. A senior who checks and finds out they do not qualify loses only a few minutes. A senior who never checks and did qualify can lose real money. That is an easy decision. Check. So here's the move. If you were born before January 2nd, 1961, do not treat this like another ordinary tax year. This is a new deduction year, a new schedule year, a year where one extra question may separate the senior who claims what they are allowed to claim from the senior who signs too fast. Remember what this is. It is not automatically a $6,000 check. It is not for everyone. It can phase out. It has eligibility rules. But if you qualify, it can reduce taxable income by up to $6,000 for one eligible senior, or up to $12,000 for a married couple when both spouses qualify. And the difference between receiving the benefit and missing it may come down to whether the return was completed correctly. So do not rely on hope, rely on proof. Find Schedule 1A, check Part 5, confirm line 37, ask about the 6% phase-out, verify filing status. Make sure line 38 flows to Form 1040 line 13B, then file, because the IRS is not going to care that you meant to claim it. The IRS is going to process what you actually filed, and for seniors, that difference can be expensive. If this helped you, subscribe to Seniors Heaven. I will see you in the next one.